Okay, welcome back to Switzer, one of the most reliable predictors on where markets are going and which sectors we should be in is Professor Ron Bewley from Woodhall Investment Research. And he joins me now in the studio. Ron, how are you going?
I'm good.
Is that a dangerous thing for me to call you an accurate predictor?
Well, it depends what you mean by accurate. You can't always get it right.
No, but yeah, I give latitude. And
I won't need any tonight, though.
Okay,
not so far, at least.
All right, mate. So, what's the things you're seeing now? Do you want to talk about tonight?
Well, what I'd like to get across is the fact that the last week or two with the market dipping and coming back was entirely predictable, and I did predict, not on the day, but that would happen at the beginning of the year. So how do you go about that? So rather than just saying, I think it'll be so-and-so at the end of the year, how do you give an investor more feeling about what the range is going to be over that period? And this is the work I did over Christmas.
Okay.
And I did a bit on the show with Martin.
Okay. So will the charts you've got tonight allegedly explain all this?
I think so.
Okay, good. Well, let's go to the first chart, right?
If we would.
And before it comes up, just tell us what we're going to see.
So this is just the ASX since Jan 2012, with my forecast for 12 months, for 12, 13, 14. Obviously, I can put ones in the middle, but the graph gets too complicated.
Okay.
But oh no, it's the wrong one, Nat.
Wrong one. So just try that. Wait, keep on talking, right?
No, it really spoils it. I'll just talk about the other one.
Yeah.
So showing the ASX, and there's like a diagonal line showing where you go over the year and where you would finish up.
Yeah.
Yeah. But we all know that the market doesn't go in a straight line. So
is this it, Ron?
Yeah, that's it. Beautiful.
Thank God for that.
Yes. So the wiggly grey line is the ASX 200.
Yep.
And then you've got the red line, black and green for the different calendar years.
Okay.
And you can see that the forecast weren't too bad where the diagonal line goes. But what I've been able to do now is add the dotted lines on, which is my prediction for the high and the low of each year.
Okay.
Without saying when it's going to occur.
Explain to my guest, the green one is the forecast for 2014,
yeah,
right?
We're going to do that.
It's a straight line. And one day you'll put the little jagged line, which is the reality one.
Yes.
But what you've done is you've put in your anticipated high.
Yes.
And your anticipated low.
Yes.
Now, we're already around the low now.
Yes, but if we go back to the red first, you'll see that when the market fell dramatically in around, I think it was May 2012,
we went sideways.
it got down to the low.
Yeah.
So it wasn't really a surprise, so you don't get upset. Whereas if you don't know where the low should be, you've got no idea, then you get worried.
Yep.
And then it charges up near the end, and of course, once you hit the low, it's harder to get to the high because you've got less time to get there, and you're going further down. And then you get the black one in the middle, where again the forecast wasn't bad, and the high was pretty much spot on again. So that's getting it. So as you say, now we've got the green thing. So on Jan 1, it was 53, 52, I think.
Yeah.
And the market had been screaming up, and some people were saying the world is going to be wonderful. And I said, yes, the world is going to be wonderful, 58.50, but it's going to go via 51.50.
Yep.
And
you talked about sideways to slightly down, but nothing dramatic.
And it's not sort of magic stuff. This is using estimates of volatility, which some of us know quite a lot about.
Yeah.
The returns forecasts take from brokers and joining the stuff together in the simulation. So it's not beyond the capabilities of a lot of people.
Well, let's try and just flesh out the green box, because that's the year ahead.
The next slide.
The next slide does that.
Is that. So that's what I thought you'd want.
Of course. I'm like that. I ask him
and even the next one.
I ask questions.
Well, yes. So if we can flip to the next one, which we had before. Yeah.
Okay,
this is just the last box made bigger, so you can see.
You kept it green, Ron, but okay, I'll accept that you've gone black and gold. All right.
So the red line is the market, and it fell pretty sweetly to the low of the forecast.
Yeah.
And it's bounced.
That was last week.
That was, yes, but it bounced up yesterday and day before. Yeah. And it should go up again tomorrow because the Dow's up again. And if Yellen says the right thing, we'll start screaming up.
Okay.
So you'll see the black cross on the right is the end-of-year forecast.
Yeah, that's your 5850.
Yes.
And you reckon my 6,000 is going to be very hard to achieve.
Yes.
But someone last night said 6,500.
I don't care.
Yeah, but it doesn't mean either is right. But
no, I could be terribly wrong, but I mean, I've got a reason for saying mine. I've got to stick to it.
Yeah, of course.
I can't change mine.
Okay.
But
I don't change mine either.
No, but the other guy. I don't know how the other one.
Other guys do. Okay, go on.
But anyway, the black cross is the end of year. Yeah. But you see, because markets don't go in a straight line, the chances are it'll be higher at some point before the end of the year than it is at the end.
I might get 6,000 before the end of the year.
Yeah.
Okay. But here's a good question, Ron. My gut feeling, just looking at the history of markets, is that America's going to need some kind of correction. So if we get one, that means that bottom line might be hit a couple of times before it eventually takes off again.
Yes.
What's the likelihood, do you think, of another, kissing of that bottom line before it kicks up again?
Slim.
Slim?
Slim.
Because you believe that now you're throwing your fundamental analysis, you think Elon's going to say some dovish type things, and people say, yes, yes, yes.
Yeah, and I've done all these simulations to see what sort of things happen. That's
okay.
unlikely. But what I want to show you with the gold dotted lines.
Yes.
See, as the market comes down, your lower has to go a bit lower because everything is possible.
Yeah.
But it's not going. The end of year forecast isn't going down as much as the limits.
Yeah.
So that's been quite stable. It's about 50.
So your black cross is at 5850. It could go down to 5750. You're saying?
Yeah, or somewhere between, a bit behind.
Yeah.
So this to me helps me understand what I think is going on. So I'm not surprised, and then I feel much more comfortable. In fact, I was almost willing it to happen because it's going to happen sometime. Let's get it over and done with.
Okay, I got some nasty letter from the odd disgruntled viewer who said, here you go again, jumping on with the Wall Street crew, talking markets up again. And he apparently remembers something I said in 2008. And my show didn't start until the middle of the year in 2008. And I think I started, after Lehman Brothers failed, I kept saying, I think this market's going to go up. And so I took the risk then. And in March it did. So, I was only out of the money for 6 months and we've been up ever since. But this guy apparently wanted to have a crack at me. I guess what could make you be wrong, Ron? Like you believe that from what you're seeing, it's highly likely that we'll end up higher end of this year.
Yes.
What are the most compelling reasons? And my viewers would love to know that.
Well, it would mean that the brokers haven't anticipated it, so using their forecast. Yeah. But you could get like a China problem.
Yeah.
Now people keep
talking. A left field event.
Yeah.
It's a left field event.
Yeah. I don't think that's likely. I think they're able to handle it. Yeah. But people, there's two sides to a market, as somebody said on, was it this show or something just before, that somebody's got to say something bad and something good, otherwise we never trade.
Yeah.
So you're always going to hear these noises, so you've got to be able to filter it all, and that's what I want to do. So Europe's looking really good now.
Yeah.
It started really well at the beginning of the year. The UK, best PMI in 32 months.
Yeah.
Even old England.
The old dart's coming good.
And,
but when the cricket team goes badly, the economy goes well, and vice versa.
I think we can get rid of them now. But
yeah. So you like it when your technical analysis marries up with the fundamental analysis, and that's what you're saying.
Yeah. So I would overrule this if I thought something was being missed.
Yeah. Okay. And people should understand that a lot of your analysis comes from surveying over 1,000 analysts and brokers to get what the consensus feeling is. And if they completely miss some left field event, you could be wrong. But on the balance of probability, it looks like it's another up year. Yeah. Okay.
So, just to make one clarification, I am technical by nature, but it's not the same as technical analysis as used by technical analysts who do Fibonacci and stuff.
Who often ignore the fundamentals.
Whatever.
Yeah. Let's go to the final chart.
So now I want to show, because I'm thinking of getting back into business and doing this for a living again. You asked me what's the best sector, energy, and you say what's the best stock, and I want to show here why it's difficult to answer that question.
Okay.
So I've constructed 3 portfolios on the 1st of Feb.
Yeah.
There's a high conviction one, which is the good solid blue chip type. There's the high yield for the obvious story, and the high octane for the kickers. For we've got a crash on
the thrill seekers. Yeah.
So the green bar going to the right shows you the weight for this sector is 7.9%. Yeah. But if it's high yield, it's 9%. It's 13% if it's high octane. The reason being because there are different characteristics you're trying to get out of the portfolio. So I'm not saying all stocks is the same.
Okay, hang on. Now, a lot of my viewers wouldn't understand why you use the word weight.
Sorry.
So what are you telling them?
The proportion of your portfolio you spend on energy stocks.
Okay.
So if you had a $100,000 portfolio,
so the subject is the energy sector.
Yeah.
And if you're in a high conviction portfolio, define high conviction for my...
Something that you can go to bed at night, you never really look at, and you might just buy more.
Very blue chip-ish.
Very blue chip.
Okay. And so you've got Origin in there, in that one.
Yeah.
Okay.
So it's the biggest stock with a good rating.
And out of the 100% of your portfolio, you'd have a 7.9% exposure to Origin alone. Okay.
But if I wanted yield, I wouldn't have Origin. I'd have Woodside and Worley Parsons.
Yeah.
And I'd have about equal, it just so happens to be equal there, but a bit more in there because it's a good, energy has actually got decent dividends compared to some sectors, unlike there's none in materials in that particular portfolio.
Okay.
But if you go to the high octane one, you've got even more in there, and these are really kick the lights out type stocks.
Yeah.
And when I was running these things at the bank,
hopeless on dividends. But the high octane.
Hopeless, yeah. But we were beating the index by 30% over a 12-month period often. Of course, you wouldn't hold one of those in a GFC, but they can work. And if you notice, Current Gas didn't have a good day today. But even so, the portfolio of 21 stocks is still beating the index quite handsomely after 6 weeks.
But that's only got a, well, has it got a 13.2% exposure to
energy?
Yes, energy. And
because that's where the hot stocks are. So that's where you want to be. But see, the real one to me is when you fuse the octane with the conviction, so you have a little bit of that in with the other to add a bit of spice.
Okay, so Ryan, the simple summary then is this. You think people should be in energy going forward?
Energy is a good sector, but you can't just blindly say what's a good stock and buy it.
No.
You've got to think about it.
So if you're a high conviction person, you're going Origin. If you're a yield person, you're Worley Parsons, this is really a mining services company, and Woodside. And then if you're a thrill seeker, you're a thrill seeker.
And then on your Switzer website, the Switzer Super Report, I occasionally put these sort of weights on and things so people can look at them.
Yep.
But it's a complicated thing and something to be thought about, not just what's the best stock.
Ron, as always, so you can get your stuff on the Switzer Super Report website and also your website as well.
Yes, and these slides are up there now.
Great
on
stuff.
woodhall.com.au.
Thanks, Mark. Now, before we go, we had Ben Roberts-Smith, the VC winner last year, and a lot of people have contacted me about this conference he and I are going to be speaking at. So here it is. It's the Sydney Peak Performance Business Conference. It's on March 27, which happens to be my birthday, Ron. 8 a.m. to 5 p.m. at the Radisson Blue Plaza Hotel, and the website is Peak Performance flock2.com. And so if you're interested in seeing Ben talk about his speech on frontline management, should be very good. Guys, thanks for Ron, thanks for joining us.
Pleasure.
And ladies and gentlemen, thanks for joining me on the show. I'll see you tomorrow night.